Good afternoon, everyone, and welcome to the May 2024 edition of Epic Insight. This is Jenna Fiduciario. I'm the Internal Sales Manager at Epic Retirement Plan Services, and I will be your host for today's call. With the passing of the Taxpayer Relief Act of 1997, Roth IRAs became a part of the retirement planning landscape beginning in 1998. Created by a provision of the Economic Growth and Tax Relief Reconciliation Act of 2001, commonly referred to as EGTRA, the Roth 401k made its debut in the retirement planning landscape in 2006. With these two powerful tools came many questions as to the best way to utilize the many benefits these strategies bring. To help us navigate the strategies behind the use of Roth contributions, we are happy to have our colleague from Lord Abbett to help us out. With us to lead our session is Brian Dobbis. Brian is the Director of Retirement Solutions with Lord Abbett and is responsible for managing Lord Abbett's IRA business. He will share with us how to take advantage of the many opportunities Roth IRA and Roth 401k strategies present. As a reminder, this session does qualify for continuing education credits, but it does require you to remain on the line for at least 50 minutes of the session to qualify. Your line will be muted throughout the call, but if you have any questions you would like addressed, please enter them in the webinar control panel and we will pause during the session to answer them. And with that, I will first turn it over to Jim LaPiedra.
Thank you, Jenna, and thank you for having us on the call today. Just seeing CNBC record close for the S&P and NASDAQ, so I'm assuming everyone's in a great mood and excited to learn more about these Roth strategies. As Jenna mentioned, my name is Jim LaPiedra. I'm a relationship manager for Lord Abbett, responsible for our record keeper relationships. And before we get into today's topic, I just want to give you a quick refresher on Lord Abbett. So for those of you who know and work with Lord Abbett, you know that we were founded back in 1929, just days after the great market crash. And it was at that time our founder, Andrew Lord, published in the Wall Street Journal our credo, which read, "An investment firm worthy of its name fosters a sound relationship between house and client." And almost a century later, that still remains true. Now, a few numbers to keep in mind that we have here on the slide and what I believe separates us from our peers. First is that 93 years of independent ownership. Now, we've managed money through bull markets, bear markets, wars, recessions, panics, and recoveries. Another thing to keep in mind is the partnership is run by 50 enterprise leaders that play an active role in the day-to-day management of the firm. 100% of our operating revenue comes from one business activity, and that's the management of your client's assets. We call that our singular focus. So we don't have any parent company, shareholders, or outside business lines to worry about. We focus on the one thing we do exceptionally well, and that's manage money. And lastly, we believe in delivering the best outcomes for our clients requires us to maintain a great working environment for our employees. That's why I'm proud to say that Lord Abbett was named in Pension Investments as one of the best places to work in money management in the past 3 years in a row. Turning to the business side, we currently now manage over $200 billion in assets that are managed by 180 investment professionals. Now, I'm sure many of you are familiar with our U.S. retail presence and our mutual fund lineup, but it's worth mentioning that we have over 200 institutional clients, and we've expanded globally, managing money for clients in over 30 countries. This is recognized by our ability to generate results for our clients. Joining me today is my friend and colleague, Brian Dobbis, Director of Retirement Solutions. Brian's been with Lord Abbett since 2002 and is our resident expert in everything 401ks, IRAs, 403bs, and 457 plans. I joke around, but I call him our walking encyclopedia of retirement knowledge. You may recognize Brian from different industry or broker-dealer conferences. He's our most requested speaker, given his wealth of knowledge and actionable ideas. So if you enjoyed today's presentation, I welcome you to keep up on our website. Brian puts out daily podcasts, he puts out podcasts and white papers on certain topics. So please check out our website and see what Brian has been writing about. Again, if there's any questions, please use that chat box. We'll stop around halfway through the presentation to see if there's any questions and stop again at the end. So with that, Brian, why don't you take it away?
Thank you, Jimmy. Thank you, Jenna. Thank you for those kind words, Jim. Good afternoon, everyone. Thank you for joining us. I know it's a long day. We do appreciate you spending an hour with us to talk about Roth accounts. Jimmy got me very nervous when he said daily podcasts. I thought somebody signed me up for something I was not aware of. So, Jimmy, thank you for clarifying. What I would like to do today, and let me, before I start, is again, please ask questions. I've done this seminar several times, and I know there's a lot of confusion about Roth accounts. So anything that you might have on your mind or anything you want clarification on, whether or not I cover it pertaining to Roth accounts, please feel free to type in those questions. I'm going to give you several business building ideas throughout today's session, but before we begin, I think every financial advisor needs to be aware of the new provisions that were included in the Secure Act 2.0 that affect Roth accounts. As Jenna mentioned, Roth accounts were created in the late 90s. The first Roth IRA went into effect in 1998. And then in 2006, the first Roth 401k was available. But historically, Roth accounts have always been optional. You've always been able to say to a plan participant or an IRA owner, you can do Roth or traditional, depending on your eligibility. Secure Act 2.0 has changed that dynamic. Let's jump into it. Here are all the provisions within Secure Act 2.0 that impact Roth. For example, let's start with the top. SEP IRA and Simple IRA, effective now, actually effective last year, can now allow Roth contributions. So if you are in a Simple IRA plan, and the employer offers it, it is an optional plan provision. So with each one of these provisions, I'll reference the effective date, which is on your screen, and I'll also reference whether it's a mandatory provision or it's optional. SEP Roth, Simple Roth are optional. But if the employer elects to offer it on the SEP side, you now have a SEP Roth IRA. For Simple IRAs, the employer can offer either employer contributions, a Roth contribution employer, or an employee can make a Simple IRA employee salary deferral to a Roth account. So if you run simple plans, you have clients that run simple or have simples, that's going to be something, that's going to be a new education component. And again, that was first effective last year. We now have 401k matching contributions or profit sharing contributions that can be made on a Roth basis. So Jim and I are Lord Abbett employees. Should Lord Abbett make a match and it's included in the plan, this is optional as well, we can say to Lord Abbett, I want my employer match made on a Roth basis. But first and foremost, the plan must allow it. So again, it's optional. Number two, the employee must be 100% vested. So if Jimmy is not 100% vested, he cannot have employer contributions made on a Roth basis. Say it's a graded vested schedule where Jimmy is 60% vested. Can he do it then? No, he has to be 100% vested. And then let's say Brian, I've been here, many years. I'm 100% vested. That's great. And I say to my advisor, yeah, I'm going to go with the Roth and the 401k. What else does my advisor need to make me aware of? Well, I think the big one is taxes. I'm no longer avoiding taxes on those match contributions or profit sharing. I am getting taxed on them immediately. I am going to get sent a 1099, meaning I might have to adjust my tax withholding. I might be subject to estimated taxes. So there's a lot of moving parts here with employer matching contributions on a Roth basis, which also were effective last year. Third one, no more required minimum distributions for Roth 401k, 403b, or governmental 457. This is a mandatory provision, meaning Roth IRAs and Roth 401ks both do not have RMDs. Furthermore, the amount of assets that are in a Roth 401k account are excluded from the required minimum distribution calculation. This is a very good thing. Mandatory for all Roth plan accounts, K, 403B, governmental 457. Brand new, entirely new type of retirement rule or product. A pension-linked emergency savings account. This is what is being referred to as a sidecar account. So again, let me use, say you have a client who has a 401k plan. This is an optional provision, the client can say, I want to set up a pension-linked emergency savings account where the employees could contribute. It's optional, but their contributions to this account are made on a Roth basis. There's no pre-tax deferral here. It has to be made on a Roth basis. Number two, the pension-linked emergency savings account is only available to non-highly compensated employees. So an HCE is ineligible. Number three, the maximum deferral amount is $2,500. And fourth, there's only certain permitted investments, which are such as a money market, an interest-bearing account, generally any type of investment that's principally protected. Now, some of you may be thinking, Brian, what's the point of this? Well, this is an account where an employee, a non-highly, can access this money at their leisure. You do not need to be 59 and a half. You do not need a triggering event. You do not need to separate from service. So if you have a client who's a non-HCE and the plan offers this, it's just that, an emergency savings account. It's just simply linked to their 401k plan. And again, the maximum amount in this plan, or excuse me, in this account is $2,500. As Jimmy mentioned, I write a lot of articles on behalf of Lord Abbett. There is a lengthy piece on lordabbett.com covering emergency savings accounts. Next provision, catch-ups required on a Roth basis. Ladies and gentlemen, upon a 401k participant turning age 50, they can contribute an extra $7,500 into a 401k, a 403b, or governmental 457. As it stands now, that extra $7,500 could be pre-tax, or again, if the plan offers it, Roth. So the age 50 participant has an option. Starting in 2026, and as you can see on your screen here, we're supposed to start this year in 2024, but the IRS delayed it till 2026. Any participant that has greater than $145,000 in income in the previous year and is age 50 or above must make their catch-up contributions on a Roth basis. No longer do they have the ability to do a pre-tax deferral. Folks, if you run 401k plans, I would have the conversation, start having the dialogue with the centers of influence now. It's going to be 2026 very soon. This is going to affect a lot of senior folks, and they need to be aware of what's going to happen. Furthermore, let's say you're thinking, hey, Brian, what about if a 401k plan I manage doesn't have a Roth feature? They don't still want one, or for whatever reason. How does that impact? If the plan does not have a Roth feature, no one is permitted to make catch-up contributions, regardless if you are making $145,000 and less or more. No catch-ups across the board. We do again have a piece regarding higher income earner catch-ups. And then the last one, which is getting a lot of press. I have a lot of conversations regarding this. 529 funds can now be transferred to a Roth IRA tax and penalty free. So think about your own family members, clients, prospects. If they have leftover 529 funds, which is a great problem to have, there's now the ability to move those funds directly to a Roth IRA, but there are several hurdles, which I'll cover now, that must be satisfied to receive that tax-free treatment. First and foremost, the Roth IRA must be in the name of the 529 beneficiary. So if I have a 529 account and my son is the beneficiary, I would open up a Roth IRA in my son's name, i.e. the beneficiary. The fund transfer must be moved directly, otherwise known as a trustee-to-trustee transfer. 60-day rollover is not permitted. The next two are very, very important. The 529 must have been maintained for 15 years, and you need to subtract out the last 5 years of contributions, including earnings, which are ineligible. So folks, you got to pass two tests. One, make sure the account, being the 529, has been open 15 years. And second, subtract out any 529 contributions plus any earnings, if there are any, from the last 5 years. Why did Congress create this rule? They do not want high income folks funding a 529, super funding it, and then just flipping it into a Roth IRA immediately. They want some time to let that 529 fund bake before they start doing these transfers. Furthermore, the maximum transfer amount is $35,000, not subject to inflation. Furthermore, you can't transfer the full $35,000 in one shot. It's not that simple. The maximum contribution, or excuse me, the maximum amount you can transfer annually equals the Roth IRA limit for the year, which for this year it's $7,000. So for argument's sakes, if you have $35,000 in unused 529 accounts, the most you can transfer in 2024 is $7,000. 2025, you could do another $7,000 or whatever the IRA limit is for next year, so on and so forth. Finally, a couple more requirements. The beneficiary, interestingly, is not subject to the Roth IRA income limits for the year. However, they must have income. I know, a little bizarre. So let's kind of walk through this. Let's say my son is a recent college graduate and he's a practicing attorney and started off making $300,000 a year. Could he make a Roth IRA contribution directly? No, he makes way too much. In this case, for the purposes of the 529 transfer, he is eligible because you don't count his income, the $300K, but he does need income to qualify to begin with. So again, please make sure you're familiar with all these nuances should a client approach you. If your client meets these requirements, I would urge you to work with the 529 provider. We know these are state-run plans. You call the investment house who runs it and just say, I'm looking for your process to move to transfer funds tax and penalty free from a 529 held with you, Mrs. Provider, to a Roth IRA. Again, folks, these were all included in Secure Act 2.0. You see the effective dates. They're all effective except for the high income earner, which has been delayed till 2026. Now let's talk about Roth eligibility overall. We're going to start to build that foundation and work our way, into the deep end. Everyone, regardless of income, can make Roth contributions to an employer plan. There's no income test. All the plan has to do is say, yes, we offer it. So CEOs, CFOs, centers of influence, they're all eligible. Any account owner can do a Roth conversion. There's no age requirement. There's no income requirement. Everyone across the board is eligible. However, as I mentioned a moment or two ago, there are income tests for Roth contributions, and there's two takeaways here. Number one is if you are married filing jointly, the limit is 230 to 240 for 2024. If your client is married filing separately, the limit is 10,000. Always ask your married clients how they intend on filing their taxes and document it accordingly. If you have a client, if you don't ask and they land up filing separately and they make more than 10,000, which is probably going to happen, then you made a contribution, you made an ineligible contribution to a Roth IRA. And my second takeaway is, what are these numbers based on? They're based on modified adjusted gross income, otherwise known as MAGI. So again, folks, make sure your clients, even the CPAs, the definition to determine Roth IRA eligibility is based on modified adjusted gross income. There is only two requirements in order to fund, my apologies. One requirement to fund an IRA. All you need is income. Traditional IRA, all you need is compensation. Roth IRA, two requirements, compensation and meet the income test. The only exception is the spousal IRA, folks. So this is a really good refresher for our attendees today. For those clients that are married and one spouse has no earned income, they stay home with the kids, they're maybe retired early, whatever the scenario, the working spouse can use his or her comp to fund an IRA on behalf of the non-working spouse. But again, they must file a joint return. So if you are going to be establishing a spousal IRA for a client, again, the question should be posed. Mrs. Client, Mr. Client, do you intend on filing a joint tax return? Roth appeal in opportunity. So the obvious is, you discuss funding Roth accounts with those, high income clients that are below those thresholds, those income tests. But outside of that, how can we get more clients into Roth accounts? Where are some of maybe the not so obvious, maybe things, that you're like, wow, it's a great idea. Or let's think about those folks. And furthermore, why? Why are we discussing the appeal of Roth? Well, folks, believe it or not, I know sometimes we forget this, but we are in a historically low federal tax environment. The individual tax changes or tax brackets are due to sunset after tax year 2025. So we have this year and next year. And if Congress does not pass a tax bill, we know today that we'll revert back to pre-2018 tax brackets, which for most taxpayers are going to be higher than they are today. For example, the top bracket today is 37%. It'll go back to, it'll go increase back to 39.6, for example. So folks, Roth accounts do look more appealing, especially when we get to Roth conversions. Once again, no income test for Roth 401k plans. There's three mechanisms or three strategies to get money into Roth IRAs. Your obvious, right through the front door, a direct contribution, the backdoor Roth, which is nothing new, but still an amazing strategy, which I'll cover, and of course, converting dollars. And Roth accounts are so powerful, not only for the account owner, for the ability to have that tax-free income, but you can leave a tax-free legacy. You can leave tax-free money to your kids, to your grandkids, and we'll discuss some of those strategies to get more dollars to the next generation tax-free. My first strategy, and Jim's heard me say this over the year, and I get all excited when I talk about this because clients and prospects love it. Fund Roth IRAs for the kids. There is no minimum age. You do not need to be 16. You do not need to be 18. You do not need to be 21. Simply, the child needs earned income, i.e. compensation. Think about those clients in which they have teenagers or recent college grads, or even kids in college. They're home for the summer. Are they working a job? If they are eligible. Furthermore, anyone can fund the Roth. So if my son's out working, I don't know, packing groceries at the local grocery store and he makes $3,000 this summer, I can fund the Roth IRA for him up to $3,000, meaning I don't need to beg and plead with my son to give me $3,000 of his own hard-earned money to fund a retirement account. Anyone could do it on his behalf. However, once he becomes an adult, which is based on state law, state of majority, which most states it's age 18 with a couple of exceptions, he then owns the account. So why Roth for kids? Well, it starts the 5-year hold period. Remember, ladies and gentlemen, the huge carrot with a Roth account is tax-free income. You never get taxed on the earnings, but you must hold the account for 5 years and be 59 and a half. Furthermore, Roth distributions are super flexible, folks. It's not all about putting the money in. It's also about getting the money out. And when it comes to minors, that's important. You can withdraw basis tax-free. For example, to pay for college. Say my teenager who's packing groceries is age 13. He puts in that $3,000 every year. In a few years, he's ready for college. And he needs money, right? He needs money. Maybe he just needs spending money for books, whatever. He can withdraw all his contributions, i.e. his basis, tax and penalty free. Furthermore, if he needs to dip into Roth IRA earnings, it's not there's no penalty. It would be taxable. So say he says, hey dad, you know what? I need some more money. I'm out of my basis. I'm going to dip into the earnings to pay pay for college tuition. It would be subject to income tax at his tax bracket. Remember, he's the owner now because he's the age of majority, but there'd be no 10% penalty. And finally, Roth accounts are not part of the FAFSA application. So when you establish a Roth account, it is not included. Ironically, 529 accounts are partially included because they're education accounts. Roth accounts are not because they are retirement accounts. Therefore, be prepared to explain some of the key differences between 529 plans, Roth IRAs, and the new ability to do a 529 to Roth IRA transfer. Each one of these tax advantage accounts have some positives and then some potential negatives. Like for example, for Roth IRAs, the child needs earned income. For a 529, they do not. Discuss funding Roth IRAs for your older clients, for your seniors. No age cap. If you have an 80-year-old who's still working, or even maybe partially retired, but working the gig economy, they can fund the Roth IRA. Furthermore, if both, say, grandparents are alive, you can use the spousal IRA as long as they're filing a joint tax return. So again, folks, just keep in mind that you do have the ability to fund Roth accounts. And by the way, my apologies, that's a typo on your screen. It should say 8,000 per individual, not 8,500. It's 7,000 plus a $1,000 catch up. My apology for the typo. No lifetime RMDs on Roth IRAs, and you can leave a legacy. So let me show you how we do this in my family. Let's say my mom is working part-time, and I say, hey mom, I'd like for you to fund the Roth IRA. And she goes, Brian, no way, I'm not spending the money, I'm not doing that. And I say to my mom, all right mom, here's what we're gonna do. I'm gonna gift you $5,000, or I'm gonna gift you $8,000 to put in a Roth IRA. All I ask you to do is name your granddaughter, my daughter, the beneficiary. Mom says, okay, no problem. I just funded a Roth IRA on behalf of my mom. I know it's morbid, but when mom passes away, my daughter, her granddaughter, will be the beneficiary, and now she has tax-free income for at least 10 years for the new 10-year rule. So again, folks, earned income, and again, they do need to beat the income test. So before I go on to the backdoor Roth and some further strategies, I know I covered a lot there, ladies and gentlemen. So let me stop, take a quick sip of water. And Jenna, are there any questions that have come through?
Yes, there is one regarding the 529 Roth IRA conversion. Does the annual transfer limit also reduce your contribution amount, i.e.
Excellent question.
Yeah.
The answer is yes.
And
You cannot double dip. Yeah. You cannot double dip. So if you do the $7,000 transfer, you cannot make another $7,000 contribution. No double dipping. Great question. And there is a piece on LordAbbett.com as well covering the 529 to Roth IRA strategy.
Then there was a second question shortly after the first one. It says, does it have to be zero income, or does the partial income work for the spouse? Like if the non-working spouse makes $2K a year.
Yeah, I'm going to take an educated guess, Jen, of what the question is. So let's say the quote unquote non-working spouse makes $2,000 a year, and the working spouse makes $100,000. So you have $102,000 between them. Can the non-working spouse contribute her full $7,000 or $8,000? Can they contribute more than $2,000? The answer is yes, so long as they file a joint tax return. So yes, a non-working spouse who only has, when I'm using the non-working spouse, someone who has minimal income, you can fund more using the working spouse's income. Great question.
And there was just a third question, just relating to, if they can receive the recording slides and any Lord Abbett reference materials.
I'm sorry, can you repeat that, Jenna?
Yeah. They just asked, can we receive the recording slides and any Lord Abbett reference materials?
Oh,
and
absolutely.
I know we will be out a copy of the presentation as a follow-up, but if there's any materials you had that you could provide.
We can provide you the presentation, and if you want so, we can also attach the links to a few of the articles that I referenced, if the attendees would find that helpful. Okay. All right, folks, thank you. Questions, please, we have a goal here to keep Jenna busy, so please keep those questions coming. Thank you, Jenna. Backdoor Roth, ladies and gentlemen, as I mentioned a moment or two ago, this is not necessarily a new strategy, but it is one every financial advisor should be aware of. Not just the strategy itself, but the nuances in it, because when it works really well, but there are a couple of potential landmines that you need to be aware of. But before I get into those landmines, what is the backdoor Roth, and who are we shooting for? Who are we recognizing? Which clients are we saying, hey, you know what, I think might be good for this? We are going to those prospects and those clients who cannot fund a Roth IRA directly because their modified adjusted gross income is too high. So they are phased out. The backdoor Roth is a strategy to get that high income client who cannot fund the Roth IRA directly to still get dollars into a Roth account with no tax consequence. And the first step after you identify a client who you think might be suitable for this is remembering or being aware that everybody can make a traditional IRA contribution. Case closed. All someone needs is compensation to make a non-deductible traditional IRA contribution. The confusion lies with the deductible traditional IRA. If your client would like a tax deduction, then there's a couple of hurdles to jump through. For example, whether you or your spouse are an active participant in a retirement plan, the tax filing status, and again, modified adjusted gross income. But again, we're focusing for the purpose of the backdoor Roth on the left side of your screen, the yellow. Everyone with compensation, regardless of age or income, can make a non-deductible traditional IRA contribution. And again, the spousal IRA would come into play here. So let's show an example of how this works. We have our good friend Charles. He's age 55. His modified adjusted gross income is $250K. He cannot make a Roth contribution directly. He makes way too much. Also very important, Charles has no other IRAs at this point, and I'll show you why that's so important, including a traditional, a SEP, or a simple. So Charles sends me $8,000. I contributed or fund a non-deductible traditional IRA contribution, and then as soon as the IRA custodian allows me, I turn the $8,000 and I convert it directly into a Roth IRA. Remember, everyone can do a Roth conversion regardless of age or income. And since that $8,000 was all after-tax money, Charles did not get a tax deduction. Look at that, folks. It's all tax-free. $8,000 in, $8,000 converted. Ideally, you want to do this as soon as possible, because if you wait and then there's earnings, the earnings would be subject to income tax because earnings are pre-tax. You can do this every year until Congress closes this particular strategy or eliminates it. We're good to go. However, there is a huge gotcha, and this is what the financial professional and the accounting community needs to be familiar with. And let's use our friend Kate here. Kate makes $400,000, again, way over the range. Kate is also age 50 or age 54, so she gets the $8,000 contribution like Charles. However, this is critical, ladies and gentlemen. Kate has a IRA. She has a pre-existing IRA valued at $200,000. Remember, Charles did not have an IRA. Kate does. So now Kate contributes her $8,000, so her IRA assets are now $208,000. Just like Charles, we convert $8,000. It is not tax-free. The $8,000 conversion, even though it's all basis, is not tax-free. Why? The IRS has a rule called the pro rata rule, where they are crystal clear. An IRA owner cannot cherry pick a tax result. So the IRA owner can't say, well, this $8,000 was all comprised of after-tax money. I just want to move the after-tax funds to the Roth and not get taxed anything. Doesn't work that way, folks. It's proportional based on all of Kate's IRAs. So let me stop right there. Regardless of where the IRA is held, regardless if you set up separate or distinct IRAs, makes no difference. The IRS considers all pre-tax IRAs for the purposes of the pro rata rule is one big IRA. So how does this work? Your numerator is the total amount of after-tax contributions. In Kate's case, it was $8,000. And then we divide the value of all her IRAs on the last business day of the year. So for argument's sakes, I know it's only May, but let's say for argument's sakes, December 31st, the value of all her IRAs remains flat at $200,000. It's $8,000 divided by $200,000, plus you add back in another $8,000. So again, ladies and gentlemen, that is the pro rata rule. So you need to be aware of the $8,000 divided by the denominator. So let's kind of think about this for a second. So in real world, I like to say, in the real world, how does this work? Well, when you approach your client about a backdoor Roth, in my opinion, one of the first questions, maybe the first question is, Mrs. Client, Mr. Client, do you have any IRAs that I am not aware of? If they have an old SEP, a simple at another firm, and you are not aware of, that will impact the taxation on a backdoor Roth. The second takeaway is, let's use an example, and this happens frequently. Let's say I'm your client and you ask the question, hey, Brian, you're a candidate for the backdoor Roth. Do you have any other IRAs? And I say, nope, I do not. We plug in 8,000, we flip it. I'm really happy. 2 months later, July of 2024, I call you up and say, I'm leaving Lord Abbett. I have a big IRA rollover, 401k rollover to send you. And you're thrilled. You're getting an IRA rollover. Well, what happened now? Assuming that rollover comes before the end of 2024, the pro rata rule just kicked back in because I am now going to have IRA assets on the last business day of the year. So be cognizant of that last day of the year and how the pro rata rule plays into it. What else do we need to know about the pro rata rule? A few more things, folks. Remember, Roth conversions, backdoor Roths are permanent. So if Kate didn't tell me about that 200,000 and we processed this for her and she goes, uh-oh, I can't unwind it. There's no way. That old strategy of recharacterization has been, was repealed a few years ago. How do you track this? How do you ensure your client receives tax-free treatment? Well, folks, I know we're not permitted in most cases to give out tax advice. However, I feel very strongly that communicating with your client or their CPA to ensure that IRS Form 8606, called non-deductible IRAs, is filed. This is the form that reports IRA basis. This tells the IRS, I did not get a tax deduction. Don't tax me on this. Furthermore, if you have a client that's married and both spouses do a backdoor Roth, separate 8606s for each spouse. However, spouses' IRAs are not aggregated. So if Kate is married, her $200,000 IRA does not impact her husband. So when you're discussing the backdoor Roth with a married couple, treat each spouse individually. So Kate might not be ideal because of that 200K, but you know what? Her husband might not have any IRA assets, and you can do the backdoor Roth for him. Not all IRAs are included in the pro rata formula. So this is also important, folks. So when you ask that question, Mrs. Prospect, Mr. Client, do you have any other IRAs? You need to be a little bit more specific. Why? Because inherited IRAs and Roth IRAs are not part of that proportional formula, that pro rata formula, so they're not included in the denominator. So if I have $1 million inherited IRA, another $1 million Roth, and nothing else, I can do a backdoor Roth tax-free. So it's critical as the advisor to be familiar with which IRAs are included in that formula and which are not. However, SEP and simple IRAs are included. So it's traditional IRA, rollover IRA, SEP IRA, and simple IRA that are included in that formula, whereas Roth and inherited IRAs are excluded. Roth conversions. Oh, one other thing. I'm sorry. I missed I apologize, folks. 401k, 403b, 457 assets are not included in the pro rata formula, folks. So if you wanted to go have a really advanced strategy, what you could potentially do is, assuming Kate has a 401k through her employer, Kate can take her $200,000 and roll it from her IRA into her 401k. Why would she do that? That avoids the pro rata rule because her IRA assets after the rollover are now zero, and she can then do the backdoor Roth. So you can use a 401k, a 403b, a governmental 457, or the thrift savings plan for federal employees as a conduit to high income earners be able to utilize the backdoor Roth strategy with no taxation. Jenna, questions from the group?
Yes, we have one more question. Does a solo 401k qualify to roll in pre-tax assets, assuming this would need to have a legitimate ongoing business associated?
Assuming the business is legit and it's an ongoing business, absolutely. And the plan document has to allow for it. But yes, you can take, you can do pre-tax, you can roll pre-tax assets. For example, and this might be getting a little into the weeds, but it's a great strategy, folks. Generally, for sole proprietors, the retirement account that comes to mind is a SEP IRA. Love them. They've been around forever. They're easy. Generally, once a year, the accountant gives you the amount, you plug it in, you're done. But if you want a little outside the box thinking for that, high income owner, that one-person shop, consider a one-person 401k. First thing you do after you set up the K is you do a rollover. You roll the SEP assets, which are all pre-tax dollars, into the one-person K. Now your SEP IRA assets are zero, and that high-income owner, business owner, can now do a backdoor Roth tax-free because his SEP IRA assets are now in a 401k. Whereas if you did it before, the pro rata rule would have kicked into play. And one-person Ks have many, many more benefits versus a SEP. For example, there's a catch-up provision in a one-person K, which is not available in a SEP. There's loans in a 401k, which aren't available in a SEP. And there's an abbreviated 5500 filing called a 5500 EZ, and that's only required once the assets in the K reach $250,000. It's a great question. There's a lot you can do with one-person Ks in lieu of a SEP. Anything else, Jenna?
Looks like we are up to date on the questions.
All right, great. So folks, just a couple more things here, but please, again, keep the questions coming. In this tax environment, in this market environment, there's a lot of people concerned about higher taxes, with everything that's going on in this country. And like I mentioned earlier, we may revert to the Tax Cut and Jobs Act is due to sunset the end of next year. So people are concerned about higher taxes on the federal level, which leads to more clients and prospects asking about a Roth conversion. And Roth conversions are complicated. I mean, they're easy in theory. You convert pre-tax money to a Roth account, it's tax-free. It's a taxable transaction. But you as the advisor are in a position where you can really take that deep dive with your client and see if it is beneficial for them. So what I've done for you is I created a holistic plan here and questions and to ask and dialogue to have with your client, determining whether a Roth conversion is appropriate for them. So again, let me just reiterate, everyone is eligible. So everyone can do a Roth conversion. However, for those clients who are subject to an RMD in the year of the conversion, so if you have a client who's subject to an RMD in 2024, they must take the RMD prior to doing the Roth conversion. And said another way, you cannot convert an RMD to a Roth account. When converting, the taxable income is included in the year of conversion. So if you convert this year, it's going to be included in your client's 2024 taxable income. There is no such thing as a prior year Roth conversion. Yes, you can make prior year Roth contributions, but not a prior year conversion. Be aware, Roth accounts can get messy. They're not always tax-free distributions. Should you have a client that does a Roth conversion and then subsequently needs to take a distribution within 5 years of that conversion and they're under 59.5, a 10% penalty comes back. It's called a recapture tax. So let's give an example. Let's use me. Let's say I did a Roth conversion last year and I come to my advisor this year and say, oh my God, I need money. And the advisor goes, oh, don't worry about it. You paid the taxes on it last year, Brian, in 2023. You're fine. It's all, it's all basis. Not so fast. Because I am not 59.5 and because the conversion happened less than 5 years ago, only 1 year ago, I will be assessed a 10% penalty, which the IRS refers to as a recapture tax. So the takeaway here, folks, is after you do a Roth conversion, and if a client wants to take a distribution, please see if they are subject or if they're subject to the recapture penalty or is it waived. A non-spouse cannot convert an inherited IRA to a Roth, but a non-spouse 401k beneficiary can. What? I think I just blew everyone's mind. This is one of these quirky nuances. If mom leaves me her 403b and mom leaves me her traditional IRA, I cannot convert the traditional inherited IRA to a Roth. I'm married to the traditional. If mom leaves me her 403b, I can convert the inherited 403b directly to a Roth IRA. However, the funds must go directly from the 401k to a Roth IRA. I cannot make a pit stop into an inherited traditional. So the takeaway here, ladies and gentlemen, when a client inherits an employer plan, a K, a 403b, a 457, and they're a non-spouse, have the discussion whether a Roth conversion is appropriate. Once it hits an inherited account, You cannot do a conversion. Roth IRAs, again, as we know, no lifetime RMDs, just like Roth 401ks. A Roth conversion lowers one's taxable estate. This doesn't apply for federal level. The estate tax is so high. But remember, you could also have a state estate tax. So if you're doing a Roth conversion, it reduces your overall taxable estate because you owe taxes on the conversion. Roth accounts offer financial flexibility, tax diversification, and of course, a hedge against higher taxes. What else do I need to know? Don't forget about state taxes. State taxes come in one of three flavors: the flat state tax, the progressive state tax, where if you do a conversion, it could bump you up to a higher state tax. And of course, the one we all crave is no state tax. But if you're in a high tax area like New York, New Jersey, California, be aware, make sure your client is aware of roughly what the taxes will be applicable, what tax rate will be applicable on the state level. For older clients, please ensure that they are aware that Medicare premiums Part B and D are income tested. A Roth conversion could bump their income up over the annual Medicare surcharges, which are referred to as IRMA. Now, if you do one big conversion, it would only be a temporary bump. If you do partial conversions, over a number of years, you may be subject to surcharges for several years. So Medicare Part B and Part D are based on income, and the higher your income, the more your premiums will be. And there's, I believe, 5 or 6 different levels of income tests. The same thing applies to Social Security taxation. A Roth conversion could bump your income up, subjecting upwards of 85% of your Social Security income to taxation. Also, what I refer to as the stealth tax. There's the 3.8 net investment income surtax. This was created, I believe it was back in 2010, to help pay for Obamacare, the Affordable Care Act. For those clients whose income is greater than 250, married, 200 single, say a Roth conversion bumps their income over that 200, 250K, their investment income could be subject to a 3.8% surtax. Be aware of financial aid impact for those clients who are considering, a college aid. Remember, a Roth IRA is not included in the FAFSA. But if you do a Roth conversion and you time it wrong, that extra taxable income could be included. From what I've heard anecdotally, some colleges will let you exclude it, but that's not across the board. Roth conversions could also affect other means-tested benefits, such as federal and state tax credits, tax deductions, other government-run programs. You need to ensure that you're following or you're aware of what those credits a client or a prospect is getting, and they don't inadvertently phase themselves out due to a Roth conversion. Not all IRA money that is converted is necessarily taxable. Remember, you can have basis. We discussed the Form 8606. It is critical, especially when you get a new client asking the question, Mrs. Client, I see you have a traditional IRA. Do you have any basis in there? And if they don't know, which is likely, you can then ask to see a copy of their tax return and see if any 8606 forms have been filed. That's a good thing, because if they do, those dollars will be covered tax-free. If a client is looking to do a conversion to a Roth account of simple IRA funds, please be aware of the 2-year rule. The 2-year rule says the client, the participant, must have participated in the simple for at least 2 years. If not, the conversion to the Roth account is subject to a 25% penalty. In order for your Roth income to be tax-free, you need to meet, you being the account owner, hold the account for 5 years and be at least 59 and a half, disabled, or die. Folks, my takeaway in this one is, I can't share with you how many times a client is unaware of the 5-year rule. Oh, I'm 59 and a half. All the money is automatically tax-free. You need to be 59 and a half and have the account open for at least 5 years. Again, folks, you can leave a Roth account to the next generation and they will inherit it tax-free. However, the takeaway here is, and this is so critical, ladies and gentlemen, when you inherit a Roth IRA, the beneficiary must satisfy the 5-year rule. So if mom did a Roth conversion in 2023, last year, and she never made a Roth contribution ever, and mom passes away, now I inherit it. and I say, send me all the money, it's all tax-free. It isn't, because we have not met the 5-year hold period. Mom only met one of the 5 years. I would need to hold the account for 4 more years in order for all the funds, i.e. in this case, the earnings, to be tax-free. Most non-spouse beneficiaries are going to be subject to that new 10-year payout. The stretch IRA is only available for very, very few beneficiaries, including a spouse, if the beneficiary is ill, if the beneficiary is disabled, if they're not more than 10 years younger, and certain minors. If you don't meet one of those requirements, you're going to be subject to a 10-year rule, which is still pretty generous, because you still can let dollars in an inherited Roth account accrue for 10 years, tax deferred, and likely distributed tax-free. Again, to reiterate, please ensure the client is aware. Mrs. Client, once I send in this trade, it is irrevocable. A conversion does not impact Roth IRA eligibility. So if I can make a Roth IRA contribution before the conversion, I still qualify after the conversion, even if the income pushes my modified adjusted gross income over the allotted amounts. And finally, this isn't a very popular provision, more of just an FYI if you're aware. Some plans, 401ks that is, allow what's known as an in-plan Roth conversion, where a participant takes pre-tax assets, salary deferrals, employer contributions, and converts it to a Roth 401k. But again, that has to be permitted in the plan. From what I gather, I've heard it's not all that common. Jenna, any following questions?
Yes, we have 3 questions.
Okay.
The first question is, if I complete a Roth conversion in my 401k plan, then roll the Roth 401k funds to a Roth IRA established for more than 5 years prior, does the 5-year rule still apply to the converted funds?
Oh, I love that question. The answer is yes. And I'm gonna take a moment and go into a little detail here. This is so critical. Great question. When you're rolling Roth 401k or 403b funds into a pre-existing Roth IRA, the Roth 401k funds are absorbed into the Roth IRA clock, meaning you do not start a new clock. However, when you are rolling Roth 401k funds into a brand new Roth IRA, so in essence, the rollover is establishing the Roth IRA, the 5-year clock in that case starts all over again. The takeaway here, folks, is to get all clients into a Roth IRA, whether it be a tiny conversion, a backdoor Roth, or if they meet the income test, a contribution. At least you get that 5-year clock ticking, and there's no need to start all over again. Great question.
Next question is, Benny of 401k, I'm thinking beneficiary, can you convert to an individual Roth IRA in your name?
No. So to reiterate, and maybe I was not clear, my apologies, folks. If you inherit a 401k or a 403b as a non-spouse from anyone but a spouse, you now have an inherited 401k. You can convert those assets to an inherited IRA, not to your own IRA. So let me use the example from before. If mom passes and has a 403b and I'm her Benny, I then can take those assets in the 403b and convert it into an inherited 401k, an inherited Roth, which means I would now be subject to the inherited Roth IRA rules, not the Roth IRA owner rules. Furthermore, even if I have my own Roth IRA as the owner, the accounts must be kept separate. I would have an inherited Roth and my own Roth IRA where I'm the owner. Was there one more question? Oh,
yes, there's one more. Are we able to schedule time with you to discuss further backdoor Roth opportunities?
Absolutely. If anyone has any longer one-off questions, or they want to just kind of chat with something offline, you're absolutely welcome. The contact number to get in touch with our sales desk will be provided at the very end of the seminar. All right, Jenna, am I good to go to continue? It looks like we had a couple minutes left here.
Nope, we're good to go.
All right, thank you. So folks, remember a little while ago, we were talking about Kate and Kate had that $200,000, and I kind of referenced verbally that she can take the $200,000 and roll it into her 401k. Well, I have a visual here for you, and I want to give you guys a really cool strategy. And I can tell you firsthand, several of my colleagues utilize this own strategy. So before we get into Jason here and how this works, what are we doing here? Who are we targeting? Who do we want to think about? I want you to think about those clients who own a traditional IRA, a SEP IRA, a simple IRA, and furthermore, there's after-tax dollars in there. So it's not all pre-tax. They have some combination of after-tax dollars. And how do we know if a client is after-tax? Via the form 8606. So watch how this works, folks. Jason is my client, and we're sitting down doing our review, and we determine, Jason has $300,000 in IRA assets, $200,000 in a traditional, $100,000 sitting in a SEP. But I looked through his tax return and I see Jason has a bunch of 8606s, and he has $100,000 of non-deductible dollars. He has a pretty significant amount. Jason says, "Hey, Brian, I want to get that 100K into a Roth. I don't want to pay any taxes." I explained to Jason, just like with Kate, can't do it. You're going to be subject to the pro rata rule. I can put the 100K in, but you're going to be, you're going to be subject to taxes on a portion of it. Jason's like, absolutely not. I want a way around this. This is what we do, ladies and gentlemen. We take the $200,000, which is composed of pre-tax dollars. We roll it into Jason's 401k. So of the 300, we take 200 and move it from his IRA into his 401k. When that rollover is done, Jason has $100,000 remaining. But more importantly, the 100K is all composed of basis. It's all after-tax money. So then I take the 100K, and look what I just do there, folks. I gave Jason his $100,000 conversion tax-free. What I did is I segregated and took all the pre-tax money, sent it to his employer plan, left behind the basis, and converted it. That pro rata rule I keep referring to does not apply when you go from IRA into 401k. You can never, the Internal Revenue Code is crystal clear. You cannot roll over after-tax IRA funds into a 401k, only pre-tax money. Because the code is written this way, you take Jason's pre-tax IRA money, roll it into his 401k, and we just gave him a big $100,000 conversion tax-free. Think about those clients who have after-tax dollars, or if you're unsure, hey, ask them. Just Mrs. Client, has your accountant filed the 8606? Let's see if you have any non-deductible contributions. And let's finish with this. We've got a quick moment or two left. Jenna, I'm about at time. I want to be respectful to you and your team. Do we want to go a minute over?
I think that would be all right.
Okay, I just want to, again, be respectful. I'll be brief here. Ladies and gentlemen, the mega backdoor Roth is the 401k version of the backdoor Roth IRA. So we're putting the Roth IRA on the sidelines, and right now we're going to have tunnel vision of 401k. So here we have Jocelyn. Jocelyn works for an employer that allows for after-tax contributions. Her 401k also allows for in-service distributions. So what we're doing here for Jocelyn is she's going to contribute her salary deferral. She's going to contribute her employer is going to make a match contribution, profit sharing, and she also is going to contribute $10,000 of after-tax contributions. And for the purpose of this example, ladies and gentlemen, we are focusing on the after-tax bucket. So before I go any further, think of those clients who have a 401k that have after-tax money, which also can be coded as or referred to as basis, voluntary contribution, voluntary employee contribution. Maybe you've seen it referenced as pre-86 or post-87. They all mean the same things. It is after-tax money sitting in a 401k plan. So again, I'm going to suggest that, hey, you know what, Jocelyn, let's take an in-service distribution. So she's still employed. We're going to take an in-service distribution of her after-tax money only. We're leaving everything else in the K. So she contributed $10,000. She's had a little bit of earnings of $1,000. we're going to take the 10K out of her 401k and roll it directly into a Roth IRA. No taxes. Why? Just like with the backdoor Roth IRA, it's all tax-free. As for the $1,000 of earnings, she has an option. She can convert that to a Roth, but it would be taxable because earnings are pre-tax dollars, or she can convert it to she can roll it to a Roth IRA, a traditional IRA, tax-free. At the end of the day, we just gave her a $10,000 conversion to a Roth IRA without any taxation. Now, usually at this point, someone thinking, Brian, why go through all this? Why not just leave the 11K sitting in the 401k? Why are we doing this? Absolutely, we can do that. However, by doing that, all the earnings will be taxable. A 401k is a tax-deferred plan. Whereas if she moves the after-tax money to a Roth IRA, all the earnings will likely be distributed tax-free. Therefore, what I would suggest is see which of your plans that already offer an after-tax feature. After-tax contributions to a 401k are a optional plan provision. It's like a loan or a hardship. But so the plan must allow for this. After-tax contributions are not counted towards the annual deferral limit of $23,000. So you may have noticed I've mentioned $23,000 for Jocelyn earlier. She can then make after-tax contributions above and beyond the annual limit. Now you may be thinking, Brian, why don't all plans offer after-tax contributions? This is like too good to be true. And you'd be right. The reason more plans don't offer this feature is they are subject to ACP testing, that is non-discrimination testing. So folks, if you manage 401k plans and this is kind of resonating with you, like, I think that my plan might like this, have a dialogue with your third-party administrator and ask them if the plan will continue to pass their testing if they add an after-tax feature. That is where your TPA, they know they have the census data, they'll know if they will continue to pass testing. If you add an after-tax feature and the plan fails testing, the highly compensated employees are just going to get a refund of those same after-tax dollars, and they're not probably going to be, a little disappointed. And yes, assuming the plan, assuming the numbers work and you pass testing, you can amend the plan for after-tax contributions, in-service distributions, and or, as I mentioned a little while ago, in-plan Roth conversions. Let me finish with this. In my example, Jocelyn was 45. I don't know how many of you noticed that. How the heck did we get an in-service distribution of someone who's only 45 years old? Well, folks, after-tax contributions are not subject to the 59.5 rule. After-tax dollars don't have an age requirement. Instead, it's 100% plan dependent on the plan. So a lot of plans don't even have an age limit. So point here is you can have some younger, highly paid folks make after-tax contributions and do in-service withdrawals. And yes, you can do this every year. Jocelyn every year can put in her extra 10K, do an in-service distribution, do a rollover. And finally, folks, here's your action plan. I'll be very brief since we're a couple minutes over. IRA funding, the backdoor Roth, minors, clients that have basis, the 8606, we discussed the bigger Roth, the mega Roth. Someone asked a wonderful question about the solo 401k. The appeal of Roth accounts with the lower tax brackets, no RMDs, tax-free income, and of course, as Lord Abbott's retirement guy, it's critical just to impress upon clients the importance of saving for their retirement. Someone asked a question earlier, how do you get a hold of me? Can we help you out? Absolutely. Here's the 800 line that will take you directly to our sales desk. Here's some of the other seminars and content we have available. We're here to support you. We appreciate the relationship with everyone. Jenna, thank you so much for asking me to speak today. Thank you for being the moderator. I appreciate the questions. I know we're a few minutes over, but if there's any further last minute questions, I am happy to take them.
It does not appear that we have any remaining questions.
All right. Well, I just want to say thank you.
Well, yes, we wanted to thank you as well. And thank you all for joining us for this Epic Insight webinar. As a reminder, you'll be receiving a copy of today's presentation as a follow-up. And as always, we wish you safety and health as you support your families, colleagues, and clients. Please contact us if there's anything Epic Retirement Plan Services can do to support you in your efforts. Thank you, and we look forward to having you join us for an upcoming edition of Epic Insight.